Hi value investors, welcome to my channel. Investing in individual stocks is not that easy as some people may think, and that is because it implies to read the annual reports, to understand the business model of the company, to understand the strategy of the company, to see if the management has been shareholder oriented in the last 10 years, in the last 5 years, to understand, of course, the growth prospects of the company, the tailwinds of the industry. I mean, there are lots of information that we need to consume in order for us to take the decision of incorporating a certain stock to our portfolio. But on the other hand, we have the possibility to invest in ETFs or in index funds. For example, those ETFs associated to the S&P 500, which could give us the possibility to earn something like 8, 9, or even 10% annual returns compounding for the very long term. But there should be other alternatives that enable us, that does not imply to make research in individual stocks, but at the same time give us the possibility to earn a higher returns than those returns compared of the ETFs or those compared of the index funds. And that's how the magic formula emerged as an alternative. I could notice about this process reading this book, the Little Book That Beats the Market of Joel Greenblatt here. Well, this is the Spanish version, and well, I encourage you to read it. I could study, to study the details about the process and what are the requirements to follow this process and be successful using this strategy in the long term. But first, I was curious about the results, and I want to show you what were the results of this process for 20 years. So here are the results, for example, of the magic formula, taking into consideration more than 3,500 stocks with a market cap bigger than 50 billion here. In a sample from the year 1988 to the year 2009, the magic formula was able to deliver 23.8% of annual returns compounding, whereas in the case of the S&P 500, taking the same periods, the same years, the S&P was able to deliver only 9.50%. So as you have seen here is that there is a substantial difference about the returns offered by the magic formula compared to those returns offered by the S&P 500. And in order to have a better picture and to think in a very long term, imagine that you are saving money to afford the education of your kids when they are getting into the university. So you will need to afford all those high expenses, for example, here in the next 20 years, okay? So I will give you that example here. Look at this. You are investing $10,000 here, and you are putting that money in the ETF associated with the S&P 500. So it is expected that you will get something like 10% annual returns compounding here. So in 20 years, you will have something like $67,275 in your account. I would say that it's not that bad, but of course, I would tell you that it's not good enough. Look at this. What happens if you are putting your money here in the magic formula in order to have a better returns of something like 20% annual return compounding here. So if you are using the same $10,000 in 20 years, you will have $383,376. So I'm sure that it is a substantial difference between what the magic formula could offer to you and compare it what the ETF of the S&P 500 could offer to you in 20 years. So as you have seen here, the magic formula can give you the possibility to earn a substantial annual returns over the long term. But it is important to gain confidence. And in order to gain confidence, we need to understand the process. We need to find out what are the metrics that the magic formula is using to give you a list, because it is the magic formula that will give you a list of different stocks that you will need to incorporate in your own portfolio to use the magic formula. But first, we will need to go to the website directly in order for you to understand a little bit better about the website, because this is a website created by Joel Greenblatt. So in that website, you will find out what is the list of the stocks that you will need to incorporate. And then, well, there are lots of information in order to enrich your experience and enrich your knowledge about the magic formula and take advantage of it for the very long term here. So this is the website here. This is the website, the www.magicformulainvesting.com. And here, well, this is a website created by Joel Greenblatt here. Well, you have different parts here. This is the book here, the little book that beats the market, and well, this is all the process that you will need to read in order to know more about this process. Then this is the stock screener that I will explain to you later, and well, this is the frequently asked questions. Here you will need to read this in order for you to have a clear picture about how to use properly this process. Then, well, this is the stock screener. Well, you will need to, of course, to register here. And then, well, there are two requirements here: the minimum market cap and the number of stocks. Here, the minimum market cap, well, you can put the minimum market cap of whatever you want. But I would recommend something like this. 1 billion market cap could be really good, because, well, if you don't like so much about the volatility, you will want bigger companies in your portfolio, and in order to have this bigger company, well, you will need to select a minimum market cap of minimum 1 billion here. So then you have the possibility to select of 30 or 50 stocks. Well, we will select 30 stocks at first here and get stocks. These are the list from which you will need to take certain stocks here to construct your portfolio. So I will explain a little bit more about what is the process. I mean, what is the criteria, what are the metrics in order to construct this portfolio, in order for you to gain confidence in the process, because in the end, the most important thing here is that you really need to believe in the process. The critical thing here is to trust in the process for the very long term. So I will explain a little bit more about that process here. So these are the two metrics that are used by the Magic Formula to give you all the list that I just presented to you in the website of the Magic Formula. So here, all those companies, when we are selecting, for example, the top 30 and the top 50 different stocks that we want in the list of the Magic Formula, those stocks were selected from a total group of more than 3,500 different stocks. And if those stocks are part of the list of the Magic Formula, I mean the top 30 or top 50, it means that they have the best combination of higher return of invested capital and higher earnings yield here. So look at this. In the case of return of invested capital, it is the earnings before interest, expense, and taxes, which is divided by the net current assets plus net fixed assets here. So we are taking just the tangible assets and we are removing totally the intangible assets here. So this is the total capital invested. So here, these total assets are financed by the total equity of the company plus the total debt here. So when we have, for example, a company that is using so much debt, but this company is using all that debt to buy the wrong assets that are not producing earnings, assets that are not producing free cash flow, these earnings before interest, expense, and taxes will not increase in the same proportion as in the case of the denominator. So most likely, the return of invested capital of those companies will be lower, so they will not be considered as part of the top list of the Magic Formula. This is one of the reasons why we are not considering the return of equity as one of the metrics in the Magic Formula. And this is because, well, we have the net income divided by equity. So the main weakness of this metric is that it is not considering the possibility of companies that are using so much debt to increase in an artificial way their return of equity here. So if they are not using all that money to buy productive assets, they could increase as well anyway their net income, but that doesn't mean that they are increasing their net margins or that they are creating value for the shareholders. So that's why Joel Greenblatt proposed the return of invested capital instead of the return of equity here. Now, in the case of the earnings yield, the most commonly used earnings yield that we know really is the earnings per share divided by the price. If you reverse that, this is the price over earnings, the price to earnings ratio that we use to determine if a company is relatively cheap or relatively expensive, okay? But we have the same problem as in the case of the return of invested capital here, because if we have a company that is using so much debt to increase in an artificial way their earnings, they will increase in an artificial way their earnings yield. So we could wrongly incorporate those kind of companies in the list of the Magic Formula. So in order to remove all those companies, Joel Greenblatt proposed the earnings before interest, expense, and taxes divided by the enterprise value here. In the enterprise value, you should remember that it is the market cap plus the total debt minus the cash. So if a company is using so much debt, it means that it will increase the denominator here because it is using so much debt here. But if the company is not buying assets that are creating more value or that will produce more earnings. So these earnings will not increase in the same proportion. So the earnings yield will tend to decrease. So those companies that are with the lowest earnings yield and with the lowest return of invested capital will be located at the bottom of the list of the magic formula. So they will not be part of the top 30 of the top 50 list that is presented in the website of the magic formula. So probably you're asking yourself why we are considering the earnings before interest, expense and taxes instead of the net income here. And the reason is because, well, in order to make a proper comparison among different companies, it is important to just focus on the core business of the companies here. You need to take into account that the companies, if we consider the net income, we will consider the different tax structure of the companies, the different cost of capital structure. So the profitability could be influenced by these two variables, and we don't want that. We want to make a proper comparison among different companies in order to see what is the real profitability, taking into account the core business of each of the companies that are part of the list of the magic formula here. So here we have the list of the return of invested capital and earnings yield here. All the list of the 3,500 different stocks here. This list is put in order. So we are starting with the company with the highest return of invested capital to the company with the lowest return of invested capital here. And then we have the same list of companies of the same 3,500 different companies, but of course they are put in a different order here most likely. So here we will have the company with the highest earnings yield, and here in the position 3,500 with the company with the lowest earnings yield here. We need to understand that the earnings yield is the earnings before interest, expense and taxes divided by the enterprise value. So if we make the reverse, I mean the enterprise value divided by the earnings before interest, expenses and taxes, we will have the multiple. So the company that is placed in the first position with the highest earnings yield, it indicates that it is the company that trades at a lower multiple or that is cheap. And here in the last position, this is the company that is trading at a higher multiple, so it means that it's expensive. Okay, so the main purpose of this part is to understand how to construct the combined list, because really this is the list that is constructed based on the best combination of companies with the highest return of invested capital that are trading at lower multiples. Okay, this is important because this will be the list that will appear in the website of the magic formula. So for example, what happens if we have a company A that is placed in the first position of return of invested capital because it has the highest return of invested capital, but it turns out that the same company is placed in the last position in the list of the earnings yield. So that means that the company, yes, has the best return of invested capital, but that is trading at a really high multiple. So this will be placed in the position. We just need to sum these positions, and then this company most likely will not appear, will be placed at the bottom of the combined list, which means that if we are only interested in the top 30 or top 50 companies, this company most likely will not appear in the list of the magic formula, just because it has a really bad combination of return of invested capital and earnings yield. What happened with a company, for example, a company V that is placed in the position 8th. So this company V has the 8th position in return of invested capital, but it turns out that this company has the 16th position in terms of earnings yield. So that means that this company will have the position 24 in the combined list. So this company most likely will appear in the list of the magic formula because it has a better combination of higher return of invested capital and earnings yield. Look at this. In the case of A, if we compare A with B, we could notice that V has a lower return of invested capital, but here the company V is trading at a lower multiple than in the case of A. So that's why that is the best combination, and this company V will be incorporated in the combined list. Okay. Now what happened, for example, with the company C that is placed in the 12th position in terms of the return of invested capital, but it is placed in the second position on earnings yield. So this is trading at a lower multiple here. So it means that the company really will have a position of 14 here. So this company has a better combination than B. So most likely, with a higher probability, this company will be incorporated in the list of the magic formula in the top 30 or even in the top 50 companies that you will see in the website of the Magic Formula here. Well, this is the schedule that you will need to follow if you want to use the Magic Formula process here. You will, of course, we will assume that you will have something like 20 different stocks in your portfolio, but you won't need to buy them all of them at the same time. Okay, so first you will need to establish a first group here, a first group of buying to buy 7 different stocks at first. Okay, if we start, for example, in March 2022, you will need to buy 7 different stocks from, and you will need to go, of course, to the list of the Magic Formula, and you will need to select 7 different stocks. Not necessarily need to be the top 7. It could be any of stocks in that list, in top 30 or top 50. Now, once you establish here, you need to be aware that you will need to allocate the same amount of money for each of these stocks here, for each of the 20 different stocks. Okay. Now you will need to make a follow-up, because once you buy in March 2022, you will need to hold these stocks, this first group, for the next 12 months. So it means that you will need to sell at the end of February 2023. Okay. The second group, after 3 months of buying in March 2022, in June 2022, you will, after 3 months, you will buy your second group of 7 different stocks, allocating, of course, the same amount of money to each of them. Okay. And then, of course, you will need to sell these stocks after 12 months. Okay. So if you start in June 2022, you will need to sell this group at the end of the May 2023. Okay, so the third group, once after 3 months in September 2022, you will need to complete your 6 remaining stocks in order to complete your portfolio of 20 different stocks here. And then in this group, you will need to hold these stocks for the next 12 months. So it means that if you start in September 2022, you will need to sell them at the end of August 2023. Okay. Now, once you get at the end of the month, after 12 months of holding in the first group here, you will need to sell all your stocks, and you will need to go directly to the website of the Magic Formula in order to see what is the list. You need to remember that the list of the Magic Formula is updated day by day, and of course the quarterly results are changed in each company. So the list that you have seen in March 2022 could be completely different from the list that you will see at the end of February 2023. Okay, but what happened, for example, if you see if some of your stocks are being repeated in the list in February 2023, it means that you won't need to change them. You will need to hold them, and you will hold them for the next 12 months. And those stocks that are not being repeated, well, you will need to replace them in order to complete your group. Okay. So if two stocks are being repeated, well, you won't need to change them. You won't need to sell them. You will hold them for the next 12 months. And the rest of the stocks, of the 5 different stocks, well, all of them are not being repeated. It means that, well, you will need to sell them, and you will need to replace them. You will need to buy other 5 stocks in order to complete your seven group of stocks here. Okay, so this is the kind of process that you will need to follow, because, well, this is a process that will start in March 2023, and then you will need to sell this group again, because you are starting a new process for the first group here. You will need to sell in February 2024. Okay. In the case of the second, well, you need to know that you will need to sell the second group in May, at the end of May 2023, and you will need to replace your group at the same time. So you will start again a new process with the second group here, and starting in June 2023, and you will need to sell in May 2024 here. And in the case of the third group, well, in the third group, you will need to sell in August 2023, and again start a new process until August 2024. Okay, so this kind of process will need to be followed at least for the next 5 or 6 years, in order to really have a really long-term perspective and have the benefits of using this processing of the Magic Formula for the long term. Because you know that the 20% of annual returns that the Magic Formula is promising is not guaranteed in the future, but I'm sure that this is the key. This, according to different studies, the returns obtained by this process is better than the returns of by the index funds or by the ETFs of the S&P 500. Well, in this part, I will explain a little bit more about the budget that you will need to allocate for this process. If you want to start with this process, really, for example, we will assume that you want to allocate $10,000 here to invest in the magic formula. Then you will consider that we will have something like 20 different stocks in our portfolio. So it means that the maximum amount allocated per company will be 10,000 divided by 20. It is $500 per company here. Okay. Okay, now we go directly to the magic formula. Okay, you register in this website and you establish that the minimum market cap is 1 billion here. So the number of stock, well, you can select top 30 or top 50. We will get the top 30 here. So this is the top 30 here, and well, we will take the seven first, the top 7 here. I mean, it doesn't matter if you select different companies to select your first 7 stocks in your portfolio. You can select any of these companies here. Okay, there won't be any difference in the end. Okay, but we will assume, in order to make it easier for you, we will take the first 7 stocks here, and then we will put this Academy Sports, Altria Group here. You are looking this Altria Group, MMC Networks, Artcore Inc., Voice Cascade, and so on. Okay, here Buckley and Crocs. These are the first 7 stocks that you are selecting here. So well, you will need to take notes about the cost price and shares and the amount allocated here. So the cost price, well, you will go directly to Google if you want. You just put Academy Sports stocks, and then it will appear here the what is the price that you will need to pay here. Well, you will pay something like 37.32 here. So you will need to divide the maximum amount allocated per company, and you will need to divide this, and you will get something like 13.40 shares. You will need to approximate here. So if you take, for example, 14 here, you will surpass your maximum amount allocated per company. So you will take only 13. Okay, 13, and in that way you will need to invest $485.16 according to this price in this company. Now we will go directly to Altria Group here, and the cost price here is $52.50 per share here. So well, we just need to divide the maximum amount allocated per company divided by the cost price here. So we will have something like 9.52. So in this case you will take only 9 shares. In that way you will allocate a total amount of money of 472.5, which is of course lower than the maximum amount that you just established at the beginning, which is the $500 per company. Okay, in that way you will continuously establishing the cost price. Of course you will look for the cost price, and you will establish what is the maximum number of shares that will need to buy in order to not surpass the maximum amount allocated per company that you are establishing at the beginning here. Okay, now you will need to take the date of course of I mean, you will need, if you are starting for example in March 30, 2022, you will need to buy on this date all these companies for the 7 different for 7 companies of your first group that will be incorporated in your portfolio. Now you need to of course you need to make a follow-up, because these companies will need to be sold in March 2023. Okay, then after 3 months here, in June 30, you will need to buy the following group here, and you will need to make the same process as in the case of the first group. Okay, so here for example we go directly to the Dell Technologies is another company that will be part here. We will take Dick's Exporting Goods, Fulgent Genetics, and so on. So in this way we can complete the second group here with the respective cost prices, looking into Google, looking into Market Watch, looking into Market Screening. I mean, there are lots of resources in which, or even Yahoo Finance, you can find the cost price, the current price of all these companies. Okay, so your work is basically to determine what is the maximum number of shares that you will need to buy in order to not surpass your maximum amount allocated per company here. The same thing could be said respect to the after 3 months. I mean, you should remember that we are in the second group. You will buy this company in June 30, 2022, and you will need to sell them in June 30, 2023. Okay, then after 3 months here in September, we will need to buy the last group. I mean, the remaining 6 companies in order to complete your portfolio of 20 different stocks. Here you will need to, of course, to buy to establish the cost price, to establish the what is the maximum number of shares, and of course all the amount of money that you are paying here for each of these companies. And then, well, you will need to sell them in September 30, 2023 here, okay? So you will need to establish here all the gains and loss in this and all these companies here, okay? Now, in this part, you will need to start a new process because, well, you will need to replace your first group because you remember it is supposed that you will need to sell those stocks of the first group in March 30, 2023. So you will need to replace this group with other companies. But what happened, as I told you before, if some of these stocks are being repeated, because if you go directly to the Magic Formula list, the Magic Formula is updating day by day, and of course the quarterly reports are updating as well. So it is likely that you will find other companies in March 2023. Okay, so most likely, well, it is possible that some of these stocks could be repeated. For example, in the case of Academy Sports and Altria Group, imagine that these stocks are being repeated in the list, so you will keep them as well. You will keep them. You will need to sell. You won't need to sell them. You will keep them for the next 12 months in the second when you are starting again with this process for the first group. And then, well, the other ones will need to be replaced. I mean, you will need to sell those stocks. You will need to take notes about the sell price in those stocks, and then you will need to buy other stocks in the list of the Magic Formula. Okay, in order to complete your first group of stocks here. Okay, so you will start again a new process here in March 30, 2023, and you will need to sell them in March 30, 2024. The same thing after 3 months. Well, you should remember that you will once we are in March 30 here, and you are starting this in your second process of the first group, you will need to make a follow-up, because in the second group you will need to sell these stocks here in June 30, 2023. So you will need to apply the same process as in the case of the first group. Again, after 3 months, on September 30, 2023, you will need to sell them. You will need to apply the same process here in order to replace the third group, and continues with the process again. So if you have realized, really the process of the Magic Formula is not that difficult. It implies that you need to be used with the process, and of course you will incorporate those 20 stocks in your portfolio without any problem. But you will need to trust in the process, because if you don't trust in the process, you will quit. So there are some important things that I want to mention here. Of course, according to different studies provided by the book, the book that beats the market of Joel Greenblatt, he provides all this data for 20 years of the Magic Formula. And well, it was established that the Magic Formula could give you something between 20% annual returns, 25 annual returns compounding. So this is really an important returns that surpass, of course, those offered by the S&P 500 or even by the market. But the important thing to understand is that in all these studies, there were years, for example, 1, 2, or even 3, or even 4 years, in which the Magic Formula really was underperforming the returns offered by the market. So what happened if you are starting the process and it turns out that in your first 3 years, your process is underperforming the market? You are getting lower returns than the market. So that of course could be discouraged, and that's why I encourage you to think in the very long term. If we anticipate that if there is a possibility that 2, 3, or even 4 years, Magic Formula can give you returns that underperform those of the market. So we need to really think in the very long term. We need to think really to use this process for at least 5, 6, 7, or even 10 years would be better. With all that time, you will increase so much your chances to get a better return than the market. For me, that's the only thing that makes sense, because there are other YouTube channels that are promoting the use of this technique, of this process of the Magic Formula, but they are recommending at least 3 years. I'm sure that just 3 years is not good enough, because in those 3 years, it turns out that the Magic Formula can give you just underperforming results. So to compensate for all those years, for those 2 or 3 years that you could have you could get lower returns than the market, it is important to have a long-term horizon of more than 5 years. So if you really have enjoyed this video, please put a like if you consider this is a video that is adding value to your investment knowledge, and consider to subscribe because I will continuously delivering more and more information about the value investing. So I hope to see you in the next video. Peace.